all of the gold companies I cover, all of them are trading at significant discounts to their 2-year average multiple and their 5-year average multiple. And that's whether you look at price to net asset value or EV to EBITDA or price to earnings even. So on all those metrics, they're trading at a pretty significant discount. So you don't even have to be necessarily bullish on gold to make a strong fundamental case for these mining equities. Every management team I talk to is on the same page. It's we want to maximize free cash flow. We want to return more capital to shareholders, and we want to grow, but we're going to be smart about it. We'll do brownfield instead of greenfield expansion. We'll be very strategic about near mine exploration rather than, again, a greenfield type of project. So everyone's trying to be smarter with their cash. And I think that just bodes well for the fundamentals of these companies. Step away a moment from all the different metrics that they're reporting on, and really try to focus on these handful of key things that miners should be doing a better job of to actually be better on ESG, not just what they report, but how they actually perform.
Well, hello and welcome to One-to-One Mining Investment Americas. We've got another session today focusing on gold and gold equities. And I'm very pleased to be joined by Fahad Tariq, who is Vice President of Equity Research and Precious Metals at Credit Suisse Securities, based in Toronto. Fahad, thanks for joining me today and taking time to discuss some key themes within the gold space.
Yeah, great. Thanks for having me.
Welcome. The gold price and the gold mining equities seem to have been going through something of a correction over the last 6 months or so. And I just wanted to get your view on why this has occurred and some of the factors that might have been contributing to that.
Yeah, so great question. So why don't we rewind a little bit and think about what happened maybe about a year ago, maybe a little less than that. So, one of the key things that happened with the onset of the pandemic was you saw central banks around the world slash interest rates, right? Real rates fell very quickly, and that in turn was positive for gold. We always tell investors, you can look at a million different factors when it comes to gold prices, but the one that seems to have the best correlation historically, or at least in recent history, has been real rates in the US. So the lower the real rate goes, the higher the gold prices are, and vice versa. So what we saw through the summer of last year was real rates kept getting lower because the US Fed slashed interest rates to near zero. Inflation expectations kept increasing with increased monetary and increased fiscal stimulus, And so you saw gold prices hit all-time highs in August of last year, right? Just a little north of $2,000 an ounce. What's happened since then is obviously gold prices have declined about 16%, and now we're just a little north of $1,700 an ounce. Still a very good gold price for the producers, and we can touch on that. But the real factor as to why that decline happened was, again, it's tied to real rates and it's tied to nominal rates as well. And despite the Fed saying that they're going to keep nominal rates near zero through 2023, that stance has not changed at all. They continue to be just as dovish as they were last year. The bond market is pricing in rate increases before 2023, right? So there's a disconnect between what the bond market is doing or pricing in and what the Fed is saying overtly. So as a result, you saw nominal rates rise. You saw real rates rise a little bit less than that because, again, the real rate factors in inflation, and inflation expectations are higher than they've been previously. So again, the real rates rose. You saw gold come off. That's been the main factor. Now, people point to all sorts of things like geopolitical issues, clarity on the U.S. Elections since the election, et cetera, all sorts of other things. But again, focus on the rates, and you'll get a good idea of kind of where gold is headed, or at least an explanation of how it's performed.
Yeah, absolutely. Excellent. Are there other macro factors that play into that though as well, like inflation returning, and then sort of the idea of gold as a hedge, and then eventually that trickling down into wanting to own mining equities as a result of that? Does that play in as well?
Yeah, so really good question. So yeah, inflation expectation is probably, or a hedge against inflation is probably the main reason you saw investors pile into gold last year, and you're still seeing positioning this year. One thing I'll say is I think inflation expectations versus real world inflation data that we'll see in the second half of this year, there could be a disconnect. So for example, the US Fed is saying they see just a little north of 2% inflation later this year. But practically speaking, if you look at your everyday life, whether it's things you buy, or cost of travel, et cetera, like things that if you look up these prices, you can see that the real world inflation data suggests it could be much higher than that. And so I think if you get into the second half of this year, there's a good chance that you'll see real world inflation data that's actually a lot higher than the Fed's expectation. And again, that would be positive for gold. So our view, for this year is that gold will average about $1,900 an ounce. Again, today we're at a little north of 1,700, so obviously we're more bullish on gold. And the basis of that is this idea that real inflation data will be a lot higher than what people are expecting. And so that will continue to push down real rates and continue to push gold higher. The other factor related to inflation hedge, which is interesting when I talk to investors, is, believe it or not, there is something known as a Bitcoin effect. And by that I mean there are institutional investors that I talk to that are now considering or have positioned in Bitcoin in addition to or rather than gold, right? So although I can't quantify it, what I would say is, I think if Bitcoin did not exist as an asset class, I think gold prices would be higher today because there would really be one historically proven inflation hedge, whereas now arguably you have kind of two asset classes that you can invest in: Bitcoin on the one hand and then gold on the other hand. Now, again, I'm not saying that they're necessarily, they have the same characteristics, but that's how investors are viewing it. And so to your point about inflation hedges, that's the predominant reason people position in gold, particularly this year and last year. And Bitcoin is also taking away a little of that shine off of gold as well.
Yeah, absolutely. And that's really, really interesting to get that point of view, because, it's outside of the fiat monetary system. And as a result, there's a hedge there. And I think the volatility was very scary or off-putting for institutional investors. But then we see, funds and treasuries, particularly some funds over in the UK, Ruffer and large gold fund, buying into this crypto asset class. And maybe it's a case of not wanting to miss out. But again, the hedge. So you think that capital would otherwise probably have gone towards precious metals?
Yeah, it's hard to quantify, but you can certainly, from conversations, you can tell that there's a comparison that's happening, and you can tell just looking at the performance of both asset classes year to date or the past 6 months, clearly there's some allocation that's moving from gold to Bitcoin. Maybe not that much, but it exists. And look, again, going back to what is the main reason why gold is selling off, it's not the Bitcoin effect, that's part of it, but the main reason is you see real rates rising on the back of bond yields rising. Now, the one thing we didn't talk about, another constructive outlook for gold in the second half of this year is, guess what? When economies reopen, particularly in India and China, you're going to see physical demand rebound. Jewelry demand, according to the World Gold Council last year, was extremely weak, and it rebounded just in the last little bit of 2020. But I really think the setup for that could be a lot stronger in 2021. So on the one hand, if you think about inflation hedges and investment demand, that may be neutral. It may increase because real world inflation is really high in the second half of this year. So investment demand might be flat, maybe up in the second half. But on the other hand, you have central bank demand, jewelry demand, that could really pick up as economies reopen in the second half of this year. So it's something that people don't really talk about, but it's important to know that about 70% of gold, the physical gold demand, is jewelry demand.
70%. Wow. Yeah, that's interesting. Okay, great. So coming back to your price forecast for this year, you're quite bullish on that. But even if things were to sort of stay at a slightly lower band around 1740, this is not a bad price for gold mining companies, right? In terms of companies wanting to raise capital, this is still a fairly constructive period, would you say?
Yeah, absolutely. And I think this is what is lost on the market, or a lot of the investors, particularly generalist investors who are, maybe looking at the headline gold price and they've seen it come off, and that, makes them less interested in the sector. But if you talk to specialists or you talk to people who have been looking at this sector for a while, if you told investors or you told these management teams a few years ago that you're going to have $1,700 an ounce gold on average for the year, they would be ecstatic. They would be absolutely ecstatic because the margins would be so wide at those prices. And in fact, that's exactly what we're seeing. So on average, the gold companies that I cover in North America, their all-in costs are around $1,000 an ounce, maybe a little bit north of that. You layer on top of that, they're going to spend on growth cap and expanding production and things like that. But even then, the margins are very wide at $1,700 an ounce gold. And we've had 2 quarters now, Q3 and Q4 of 2020, where we've seen this play out. Margins have been very wide. Free cash flow generation has been extremely strong. And what are these companies doing now? They're returning more and more capital to shareholders, something they haven't done historically. All of a sudden, you have investors talking about dividend yields for gold companies. That was never part of the discussion. Nobody held gold companies for the dividend. And now suddenly you're talking about 2, 3, 4% dividend yield on some of these producers. It just goes to show you how strong the free cash flow is. And so there's been a lot of self-help in the sector over the past little while. So when gold prices were flat, for the past 5-6 years before they really took off about 2 years ago, a lot of these companies, what they did was the only thing they could do. They lowered their costs, they improved their balance sheets. They really tried to pay off as much debt as possible. They were very conservative when it came to capital deployment and new projects and things like that. And all of that is paying off now because you have an environment in which, yes, gold has sold off. It's come down from all-time highs, but it is still at a level that, again, these management teams would have loved to know years ago, or would have loved to be in this situation. Margins are very wide. You're going to still see very strong free cash flow. And I think, the setup looks very good. So now when I talk to investors, I say, okay, on the one hand, let's talk about gold and why I'm bullish. But let's say you don't believe me at all and you think gold is going to be flat. Let's just say you even think gold is going to go down from here to 1,600 or 1,500. Even then, for some of these senior gold producers, the margins are very good and the multiples right now are very attractive. And in fact, we did an analysis just today where we put aside our price deck and our price forecast and we ran our models as spot gold, right? About 1,730 an ounce. And what it showed was that all of the gold companies I cover, all of them, are trading at significant discounts to their 2-year average multiple and their 5-year average multiple. And that's whether you look at price to net asset value or EV to EBITDA or price to earnings even. So on all those metrics, they're trading at a pretty significant discount. So you don't even have to be necessarily bullish on gold to make a strong fundamental case for these mining equities.
Excellent. And that's come from, quite a few years of good work, doubling down on costs, improving balance sheets, focusing on productivity, as you say. Within the companies that you said you look at within North America, is that sort of earlier stage developers and producers, or is that just producers that we're talking about here that are presenting this great undervaluation?
Yeah, so it's producers, and then more specifically, it's the senior and intermediate kind of producers. So it won't be I don't cover development or exploration companies, but the trend, I'm sure it's similar, where what you're seeing is just a real re-rating lower over the past, call it year, almost 9 months. And so the potential for re-rating higher, I think, is really there for the producers, particularly because, again, you're going to see that free cash flow generation. You're going to see more return of capital to shareholders. All of these companies are still talking about raising dividends further, doing buyback programs, doing a combination of both. And all the while still growing and having a kind of prudent plan to grow production. In the case of some of the senior gold producers, there's no rush to do that because their reserves are so massive that they have visibility on 10 years of production. But some of the mid-cap gold producers are spending more on growing and making sure they have reserve replacement. But even then, their free cash flow generation is quite strong. So that's kind of the point I want a lot of investors to take away is just assume gold stays flat, even assume it goes down a little bit. Just take a look at the margins that these companies have because of that self-help and corrections they took over the past several years. They're in a really good spot. This is not a repeat of 2011, 2012, where in a high gold price environment, a lot of these companies made very questionable and frankly, very poor capital allocation decisions. We're not seeing a repeat of that. We didn't see that when gold was at all-time highs a year ago, and we're certainly not seeing that now when gold has sold off a little bit. Everyone is on the same page. Every management team I talk to is on the same page. We want to maximize free cash flow. We want to return more capital to shareholders, and we want to grow, but we're going to be smart about it. We'll do brownfield instead of greenfield expansion. We'll be very strategic about near mine exploration rather than, again, a greenfield type of project. So everyone's trying to be smarter with their cash. And I think that just bodes well for the fundamentals of these companies.
Yeah, excellent. There's a couple of points that I wanted to focus on then. So the fundamentals are great. Do you think it's just a matter of time before investors sort of start to think, okay, it's not just the gold price that's going to dictate this. I've got to look deeper, and then more generalists will come back to gold? Or do you think there are other factors at play that might be still keeping generalists a little cautious around mining, not just the issues that happened in the last cycle in 2011, but things around ESG, for instance, where mining is an extractive business. There's certainly a trend for green stocks at the moment, or greener products, if you like. Maybe gold mining doesn't fit in that just yet.
Yeah, so great point. So maybe first just on what would it take for some of these investors to come back. So I think we've had basically 2 quarters, maybe a quarter and a half of call it slightly lower gold prices and really good performance, fundamental performance. Q4, for example, 3/4 of the companies I cover beat consensus estimates on earnings and on free cash flow estimates, right? So we saw 1 quarter of that. Q3 of last year, we had all-time high gold prices, so people kind of discount that. So we've kind of only had a quarter and a half of kind of call it these lower gold prices, in which these companies have demonstrated their strong margins and free cash flow. So I think, to answer your question, I think it would take another quarter or two, and by then you have really a trend, right? You have 3/4 of solid free cash flow generation, even when gold is way off of, 15% off of its all-time highs. I think when investors digest that and they see the Q1 print and they see the Q2 print and they see that it's kind of a continued trend, you're not seeing cost inflation, you're not seeing cost creep, you're not seeing margins, narrow. In fact, you're seeing them stay the same. When they see that, I think that's going to really help kind of drive home this point that the fundamentals are very strong at these gold prices. So that's number one. Yeah. Number two, for generalists, coming back to the sector, look, I think the gold price matters a lot because that is what gets the interest kind of going. So if you start seeing gold break out of it, it's kind of been in a kind of steady pattern for a little while. If it breaks above 1,800 or maybe higher soon, I think, that kind of headline gold price really gets people's interest going. And then thirdly, on your point about ESG, for sure, that's a huge factor. So even within the mining complex, call it, there's way more interest, for example, for copper companies and lithium companies, and much less interest I find for gold companies. That was not the case, last year. It was part of it was the headline gold price was really high, and that was getting a lot of interest. Copper wasn't really there yet, and now the inverse has happened. So obviously, you're seeing pretty high prices for copper. Lithium is starting to rebound as well. And so I find in discussions, investors are more focused on those metals rather than gold. So there is an element of that green trade. But because it's been, call it like 3, 4, 5 months of that, we might actually be, I find we're at a bit of an inflection point now where some of those themes have not played out. These are things that will play out over a long period of time, but at least, I'm having more discussions about, some of the copper names, I kind of, they've run up so much already. I'm starting to look at gold again, for example, from a fundamental perspective, or just because of the relative valuation. So I'm not saying that gold sentiment has bottomed, but at least it's starting to turn a little bit more positive. But for sure, there's a huge kind of headline momentum for some of these copper, lithium, green metals for sure.
Yeah, it's interesting. It's kind of great for mining in general, metals and mine commodities in general. But now there's sort of tussling between where does that investor pendulum swing towards the gold or the green stocks. Yeah. Okay, that's great. Well, that leads me on to sort of the M&A question, because you touched on growth there and sort of how companies have been doing really well and what they've been doing well in terms of keeping cost discipline. But there's got to be a lot of M&A on the horizon, or certainly plans to add ounces through acquisition. Do you have a view on how you see it picking up, or will it be steady? Will it be steep?
Yeah, so I definitely think the M&A theme is going to play out this year for a number of reasons. But just starting at the headline, gold prices have come off, so valuations have come off. Suddenly, companies that were looking to acquire a number of targets look a bit more attractive from valuation front, right? You don't want to be the one doing a deal when gold is at all-time highs. You don't want to be the one buying, at least at that time. Maybe you want to be the one selling. But in any case, I think you'll see more M&A because of that. So valuations are a bit more attractive, like I mentioned. The other thing is the reserve replacement challenge is very real, and I think in many ways it's taken a backseat to free cash flow generation and just returning capital to shareholders. That's become like every management team is laser focused on returning more capital to shareholders. But there's an expense to that, and the expense to that is that you are in some way sacrificing your reserve replacement maybe a few years from now. And so I think that's going to start getting more attention. You saw a little bit, there was a bit of a pass for 2020 because a lot of these companies couldn't do as much exploration as they wanted, as much drilling activity as they wanted because of COVID restrictions. So there was a bit of a pass on reserve replacement in 2020, but I think this year there's going to be a lot more focus on it. And part of the solution is, look, you can either explore and hope that you continue to find more ounces, and if you're really confident in your deposit, or you go buy those ounces either in the form of an asset or an entire company. So the gold price is conducive to M&A. I think reserve replacement challenge becoming more of a focus is conducive to M&A. Now, the question of where does the M&A happen, I don't really think you're going to see mega mergers. Like, I don't think the Newmont Gold Corp or Barrick Randgold or something like that will happen. Maybe, it's kind of hard to tell, but I don't think that's really the focus. I think it'll be more asset acquisitions or, medium-sized companies combining to get larger. That's the theme that, I expected to play out last year as well, and it did a little bit. You saw companies like Endeavour Mining make 2 acquisitions actually last year, and now they're considered a senior gold producer. I think you'll see more things like that, more medium-sized, mid-tier companies combining, more assets changing hands, less of the kind of mega mergers, if you will.
And this is smart M&A that shareholders like to see compared to some of the sensational stuff that we've had in the previous cycle, right?
Yeah, so exactly. And I think that stuff is it's a non-starter now. So just to put some numbers around it, I think obviously investors love nil premium deals, 0 premium deals. A modest premium, it's fine. Sometimes even a double-digit premium is okay, depending on the target share price. Maybe it's at all-time lows, and so a 10% premium is not kind of really a premium. I think if you're talking about what happened in 2011, 2012, when you're talking about very frequently 30, 40% premiums, that's a non-starter now. Like every investor I talk to, there's so much hesitancy around M&A and the price being paid. And so far through this cycle, we've seen pretty disciplined management teams. We haven't really seen anyone kind of considerably overpay for any deal of size, of meaningful size. Maybe there was a small dollar amount deal, but it had a high premium, not the end of the world for the acquiring company. But I think that's a non-starter. So it's going to be very sensible M&A, to your point. And even if you kind of shift gears and think about inorganic or organic growth, it's going to be very sensible exploration, very sensible expansion opportunities. Everything is about making sure you maximize, just shareholder return, free cash flow. And at the same time, obviously, these companies need to replace reserves, so they're thinking about that as well. But everything will be very sensible and disciplined. And so far, that's what we've seen.
Yep. Awesome. So you also covered silver within precious metals as well, right? What do you say is going on there with the silver market? It's had an interesting period, featuring into sort of short selling Reddit agenda, and seem to withstand that. But the price has moved up and sort of stabilized in the sort of high 20s. It's looking to be another interesting angle for investors looking for exposure to precious metals as well, not just physical, but silver gold miners as well.
Yeah, so I mean, maybe just as a caveat, most of my time and coverage is spent on gold, and then most of the gold companies I cover, they also produce silver as a byproduct. So of course, I do look at the market. So I'll say a few things, but I'm not necessarily a silver expert. But let me just say this: the demand profile for silver is very different than for gold. I had mentioned earlier that 70% of gold demand is jewelry demand. The marginal demand that really moves gold prices is investment demand. For silver, the vast majority of demand is industrial demand. And so, it's just a different dynamic. It's more closely tied to GDP growth in certain countries, the US and China, for example. There's also an element of, a green transition in there. For example, silver is used in solar panels. So that factors into the equation as well. But I mean, broadly speaking, if I think about the outlook for silver, look, I think it's going to kind of follow what gold does. I think, we've seen that historically. I know people look at gold to silver ratios and things like that, but I think broadly speaking, it'll follow what gold does. We've seen that even year to date, gold is down, silver is down. The short squeeze stuff, I think that was transient. Like I don't see that kind of playing out in any meaningful way beyond what's already happened. I think that lasted a couple of weeks, and it's kind of, thinking there's a short squeeze opportunity for a commodity is very different than an individual stock. And so I think that dynamic was just temporary. I don't think that's really going to factor in. So really watching industrial demand this year, watching what gold prices do, I think that will be a good barometer for silver as well.
Absolutely. Okay. And just wanted to focus in on some of the ESG things that we mentioned. We talked about it from the investor perspective and sort of how this is changing the mindset. Certainly something in all funds and individual investors are conscious of. But with companies that you're dealing with, what's the view from their side? Do you feel, when you're analyzing companies, you're getting the data that you need? Have they adjusted to this, the new requirements? It's quite fragmented in terms of the reporting data, depending on where you are and what you're mining, etc. So just wanted to get a view from you on how the companies do it and how you as an analyst feel they're progressing and moving with this evolving landscape.
Yeah, and you mentioned evolving landscape, which is really important. It's changing very quickly, and the standards are changing, investor expectations are changing, and so I think I think gold companies are moving pretty quickly. Actually, I would argue probably quicker than I thought they would over the past 3 to 6 months. In doing a number of things, like first setting carbon emissions targets. So a number of gold companies just in the past 3 months have set zero carbon emissions by 2050, so net neutral or net zero by 2050. They've done that. Carbon reduction targets before then, so let's say 10% or 20% or 30% reduction by 2030. Committing to electrification of their fleet, or using equipment that uses batteries instead of diesel. And then also committing to using more renewable power at the mine. So there's an array of things that gold companies are doing, and they've only introduced these measures really in the past 3 to 6 months. And so that's pretty quick. Historically, the gold sector has been pretty behind when it comes to lowering carbon emissions, really thinking about climate change, even introducing kind of novel technologies, because they go hand in hand. If you introduce kind of battery electric technology, that also helps you reduce your environmental footprint and carbon emissions. The gold sector historically has been kind of slow to adopt some of these measures, but the pace is picking up for sure. Mm-hmm. Now, I feel some sympathy for the gold companies because, to your point, they deal with a number of different reporting metrics, and they're being pulled in all sorts of directions when it comes to ESG. And so I think from my perspective, when I think about it as an analyst, is okay, let me just ask investors what are the 10 things they actually care about when it comes to ESG, and we did a whole scorecard based on this. And it's kind of the obvious things that you would think about if you were investing in gold companies. What are your carbon emissions? What's your water usage? What is your relationship with indigenous groups or local communities? What is your safety record? What are the tailings dams designs that you have? So these are just kind of the obvious things when it comes to ESG. So step away a moment from all the different metrics that they're reporting on, and really try to focus on these handful of key things that miners should be doing a better job of to actually be better on ESG, not just what they report, but how they actually perform. So I think investors are focusing a bit more on a handful of metrics, despite the number of different reporting standards that are out there.
Sure.
And they're trying to simplify their own investment criteria. There's certain thresholds that they're looking at. They certainly don't, investors don't have the time to look at, 10 different standards and try to figure out who performs best across all of them. So they're looking at a handful of factors. I think mining companies are doing a better job of communicating their sustainability strategy. So more and more companies, I find, are having sustainability events, which I've never seen before. A few of the larger gold companies, Kirkland Lake, for example, recently had a sustainability event. Barrick Gold next week will have a sustainability event just dedicated to sustainability. It's not a subset of a broader discussion. It is just talking about sustainability and their measures. We have not seen this before, right? So clearly, it's something that matters to these management teams, and they're prioritizing it. And they're prioritizing it because their investors care about it. Right? If you're a resource portfolio manager and you're investing in gold because of an inflation hedge, or you think gold is going to go up, or you want to have exposure, or it's always been part of your portfolio, guess what? Now you're applying ESG screens to it too, and you're looking for those better and managed teams hearing this, and they're responding. So in some ways, I'm quite impressed that over the past 3 to 6 months, we've seen pretty rapid in new measures. Sustainability events, more focus on this for sure. I think there's a long way to go, but I certainly am encouraged by the recent developments. And just over the past 6 months, it's been quite quick.
Yeah, it's staggering, but it's good progress. You think about all the funds that were sort of aligning themselves, LPs that are aligning themselves with Paris climate agreements and various targets of carbon neutrality, etc., then that's going to have a trickle-down effect of the companies they hold. So yeah, the majors are certainly shuffling. But within, you mentioned there were a handful of factors that the companies are sort of really focusing on, and that comes from the sort of things that the investors want to see. Was there anything that you would pick out or highlight that was perhaps a little bit lacking in terms of like getting the data available, or it's quite tricky to sort of track, or is there a bugbear for investors that G&A, for instance, it's not quite consistent across companies? Is there anything in particular?
I mean, look, when we put together our scorecard, I would say every metric was kind of very difficult, because it wasn't just that each company reported the same thing differently. If they were using different units, they were, even when it came to carbon emissions, are they including scope 1, 2, and 3? Are they including just scope 1? There are all sorts of nuances, and so that makes it difficult for every single metric. In terms of bugbears or where I think it's lacking, I mean, look, I think data around, just the environmental impact when it comes to carbon emissions, or the potential for renewable power as to supplement or to replace kind of conventional power. Just more details around that and plans around that, I think, would be really helpful across the board. I think the gold companies do a very good job of highlighting their social measures and their governance measures. Those are very well done. They highlight very, very clearly, the composition of the board, the compensation of executives, diversity, on the social front, health and safety, community relations. I think there's nuance to all of those things. They do a pretty good job on those. I think broadly speaking, I'd want to see more detail on the ESG, right? Yep. Talking about carbon emissions, more details around how they're actually going to achieve those carbon reduction targets we talked about. How are you going to actually lower carbon emissions by 30% by 2030?
Right. Practically
practically, what does that mean? How many mines are going to be renewable power? Are you investing in battery electric fleet? What are you doing, right? Are you doing carbon sequestration? Like, what are the measures that you're taking? And I think this will come over time. I think it's a good first step that they've set these ambitious targets, but now the natural next question will be, okay, well, show me the path to get there. So I think that, broadly speaking, and this is not specific to any company, but just across the sector, I'd want to see more clarity on that. S and G, the social and governance, I think are quite well done. But again, there's nuance. I'll give you an example. So for example, on the social dimension, one of the metrics that all these companies report is, community discussions or complaints, right? How many complaints did we receive? Okay. Now, a complaint can be a lot of things. A complaint can be, it was very noisy when you were building this expanding the plant. It was very noisy. That's a complaint. Another complaint could be the air quality or the water quality is compromised. Those are two very different complaints. And sometimes they get captured as a single data point, as company A has one complaint and company B has two complaints. And so you're thinking, oh, company B has more complaints. But that one complaint for company A could be a lot worse or but there's no nuance to it because they're just reporting these numbers. And so it's very hard for these gold companies to do that. You think about how much data they'd have to collect and how they would summarize it and how they would present it to investors. It's a hard thing to do. But these are just challenges that they will have to overcome. There has to be more nuance to some of these things. You can't just show numbers and compare them. It's not that easy.
Yeah.
So even on S and G, there's room for improvement. But I would say the environmental dimension is where I'd like to see more clarity on some of these carbon emission plans, reduction plans for sure.
Fantastic. Okay, well, look, Fahad, that's great. Really appreciate your insights there on the gold and gold equities market. And thanks for taking time to talk with us today.
Yeah, thanks again for having me.